Silver just did something it hasn't done in over a decade. It broke through $50, then $70, then $80, and now Robert Kiyosaki is calling for $200. But here's what nobody is telling you. The futures market is larger than the entire annual production. Margin debt is at historic levels, and leverage is building silently, invisibly, dangerously. When silver moves this fast, it doesn't rest, it decides, and what it's about to decide could separate those who are prepared from those who are simply hoping. The question is not whether $200 is possible. The question is, do you understand what silver does before it gets there? Because what happens next will test everything you thought you knew about this market. Welcome to Currency Alert. My friend, if you've been watching markets long enough, you know that the most valuable information rarely comes with fanfare. It comes with clarity, honesty, and respect for your intelligence. If that's the kind of analysis you appreciate, the kind that doesn't waste your time with hype, then I'd be honored if you'd subscribe to this channel. Think of it as joining a community that values truth over noise. And please, share with us in the comments, where in the world are you watching from today? Because silver isn't just America's story, it's a global reset in motion. Now, let's examine exactly what's unfolding and what most people are missing. Silver did not become a headline by accident. It became one because a bold prediction collided with a volatile market at exactly the wrong time. When Robert Kiyosaki speaks about silver reaching $200, people do not simply listen, they react. Not because Kiyosaki is infallible, but because his words arrive when emotions are already running high, when positions are already stretched, and when the market is already looking for a reason to move violently. Right now, silver sits in that exact emotional zone, and that should concern anyone holding this metal. Compared to yesterday, silver appears stable, holding its ground after sharp movements that left many traders disoriented. The price has not collapsed, but it has not found calm either. That alone signals something critical. Markets that move violently and then pause are not resting. They are deciding whether to push higher or correct lower, deciding who stays and who gets forced out. Now step back and examine a longer timeline. Compared to last year, silver operates in a completely different regime, a different psychological and mechanical environment. Last year, silver was building momentum slowly, methodically, allowing participants to position gradually without creating excessive stress in the system. This year, silver is managing excess, dealing with the consequences of moving too far, too fast, with too many participants chasing the same trade. That distinction matters more than most realize. Last year was about discovery, about the market finding new price levels and testing whether they could hold. This year is about digestion, about absorbing the impact of those moves and determining whether the structure can support what has already been built. Silver has already completed the difficult work of repricing itself higher, breaking through resistance levels that held for years, even decades. Now it faces a different challenge, dealing with the aftermath of that breakout, managing the expectations it created, and surviving the leverage it attracted. This is where predictions like $200 silver become dangerous if misunderstood, not because the number itself is impossible. Silver has proven it can move in ways that defy conventional expectations, but because timing is everything in markets, and timing is exactly what predictions cannot provide, silver does not move like a smooth escalator carrying passengers steadily upward. It moves like a staircase with missing steps, where the destination may be real, but the path is treacherous. Traders do not fall because the final target is wrong. They fall because they step forward when the floor is not there. When they assume continuity where gaps exist, Kiyosaki's prediction functions like gasoline poured onto an already warm engine. It increases speed, it amplifies momentum, but it does nothing to improve stability. And that is the warning embedded in this moment. When silver runs too far, too fast, belief begins to replace balance in the decision-making process. Investors stop asking whether their positioning makes sense and start assuming the prediction will carry them through any turbulence. Markets punish that assumption consistently, ruthlessly, without warning. Compare this year to last year in terms of volatility alone, and the difference becomes stark. Daily price ranges have expanded dramatically. Movements that would have taken weeks last year now unfold in days, sometimes hours. Pullbacks are sharper, more sudden, more capable of triggering forced liquidations. Recoveries are faster, but also more unstable, creating the illusion of strength while masking underlying fragility. These characteristics tell us something critical. Silver is under pressure, not losing relevance, not collapsing, but operating under intense mechanical stress. Pressure is not inherently weakness. Markets can sustain pressure for extended periods, but pressure is dangerous because it means the system has less room for error, less capacity to absorb unexpected shocks. Think of silver right now as a pressure cooker without a clearly defined release valve. As long as heat continues building, the lid rattles, sometimes violently, sometimes just enough to notice. That rattling is what participants are witnessing now, the visible sign of forces that remain mostly hidden beneath the surface. Kiyosaki's $200 call adds more heat to that system. It does not reduce risk, it amplifies it. The problem is not optimism about silver's long-term potential. Optimism can be justified by supply deficits, industrial demand, monetary instability. The problem is positioning, how participants translate that optimism into actual market exposure. Many people hear a bold number like $200 and make a critical error. They assume time becomes irrelevant, and that holding through anything is the only strategy required. Silver does not reward that mindset. It never has. Silver rewards patience, the ability to wait for proper entry points, to scale positions gradually, to maintain discipline when others are rushing. But silver punishes stubbornness, the refusal to acknowledge when positioning has become dangerous, when leverage has exceeded prudent levels, when the market is sending clear warning signals. Compared to last year, leverage in silver markets has increased substantially. Participation has broadened beyond traditional precious metals investors into speculative trading accounts, retail momentum traders, algorithmic systems chasing volatility, and expectations have grown louder, more confident, more uniform. That combination creates fragility, not strength. Because when everyone expects the same outcome, when positioning becomes crowded on one side, the market has a tendency to move in the opposite direction first, violently, just long enough to clear out excess before resuming the expected path. This is where understanding silver's general structure becomes essential. Silver is smaller than gold. Its market capitalization is a fraction of gold's, which means individual trades can move price more easily. Its liquidity is thinner. There are fewer participants willing to take the other side of large orders, especially during stress, and its dual role as both monetary metal and industrial commodity makes it more reactive to shifts in economic sentiment. When confidence rises, silver surges harder than gold. When confidence cracks, even slightly, silver drops harder than anyone expects. This is why silver can feel like betrayal to holders, even when the long-term fundamental story has not changed at all. It is not betrayal. It is mechanics. It is the natural behavior of a market with these specific structural characteristics. Kiyosaki's prediction should be treated like a weather forecast, not a calendar reminder. It tells observers that a storm may be approaching. The conditions are building towards something significant, but it does not tell anyone when the wind will shift or how violent the transition will be. Right now, the silver market is not aligned for smooth upward movement. It is aligned for turbulence. And turbulence does not invalidate bullish scenarios, but it absolutely invalidates complacency. What most investors fail to understand about silver is that its violent drops have nothing to do with belief. They have everything to do with mathematics. This is where commentary typically fails, where analysts talk about sentiment and psychology while missing the actual mechanism that breaks price. Silver does not fall because investors stop believing in its future. Silver falls because the leverage underneath it collapses suddenly, mechanically, without emotion. To understand why this matters right now, one must first understand how silver actually trades in modern markets. Unlike gold, which requires substantial capital for meaningful futures exposure, silver futures demand far less margin per dollar of notional value. That structural difference attracts a specific type of participant, the leveraged trader, the speculator seeking amplified returns from relatively small price movements. History provides clear evidence of what this creates. Silver moves approximately 1.5 to 2 times faster than gold in both directions during equivalent market conditions. This is not theory. This is observable behavior documented across decades of price data. It means silver rewards aggressive positioning during rallies, but punishes it with equal force during corrections. When silver rallies sharply, something invisible begins happening in the background. Margin usage rises across the futures complex. Accounts that were previously operating with comfortable cushions suddenly find themselves using 70, 80, even 90% of available margin. As margin usage climbs, risk increases, but it increases silently. No alarms sound, no warnings flash on trading screens. Positions simply become more fragile without participants fully recognizing the shift. And this is where one verified fact becomes critically important. The futures market for silver, the paper contracts traded on exchanges, represents many multiples of actual annual physical silver production. Read that again, carefully. More silver trades on paper in a single month than gets pulled from the ground in an entire year. That means price discovery. The process by which markets determine what silver is worth at any given moment happens primarily in paper markets first. Not in vaults where physical metal sits, not in factories where industrial buyers take delivery. In electronic markets where leverage dominates, where positions can be opened and closed in milliseconds, where physical delivery is rarely the intention, when margin requirements suddenly increase, Or when volatility spikes beyond certain thresholds, these paper positions must unwind, not because holders want to sell, but because the mathematics of their accounts force them to. Physical demand does not disappear during these moments. Industrial buyers still need silver for manufacturing. Long-term investors still believe in the fundamental story. But paper pressure overwhelms price action in the short term, creating drops that seem disconnected from underlying reality. This explains something that confuses many silver holders. How can silver fall hard even while industrial demand remains strong, while supply deficits persist, while the long-term case appears intact? The answer lies in understanding that two different markets operate simultaneously, one physical, one paper. And the paper market controls short-term price, always. Now connect this structure to the current environment. Compared to last year, silver trading volumes have expanded significantly. More contracts changing hands daily, more participants entering and exiting positions. Open interest, the total number of outstanding futures contracts, grew substantially during the recent rally phase. That expansion confirmed something critical. Participation increased, not just price. More traders, more speculators, more algorithmic systems, all stacking positions on the long side, all expecting continuation. More participants means more leverage embedded in the system. More leverage means more fragility hiding beneath the surface. This is where Robert Kiyosaki's $200 prediction intersects with dangerous reality. When influential voices project large upside targets, when respected figures in the financial world make bold calls, speculative interest grows exponentially. Not all of that interest is reckless. Some participants enter with proper risk management, with appropriate position sizing, with stop losses in place, but some do not. And it only takes a small percentage of over-leveraged participants to trigger a cascade. That additional participation raises open interest further, increases margin exposure across the system, but does nothing to increase physical supply. This creates a structural imbalance, a gap between expectations embedded in paper positions and the actual metal available to satisfy those positions if delivery were ever demanded. Think of it like adding more vehicles onto a bridge without reinforcing the underlying structure. The destination on the other side may be perfectly valid. The bridge may have worked fine with normal traffic. But at some point, additional weight exceeds what the design can handle, and something breaks. Silver's bridge is narrow, always has been, and right now it carries far more weight than last year. Another verified element must be examined here, actual supply dynamics. According to data published by the Silver Institute, global silver supply has been running below total demand in recent years. Industrial usage has driven this deficit. Solar panel manufacturing, electronics production, electric vehicle components, all consuming silver at rates that mining cannot match. These are not optional sectors. They represent structural demand that does not disappear when futures traders panic. But here is what most investors misunderstand completely. Supply deficits do not protect price from leverage-driven sell-offs. They cannot, because supply deficits operate on a timeline measured in months and years, while leverage operates on a timeline measured in minutes and hours. When margin calls trigger, when forced liquidation begins, physical supply deficit becomes irrelevant to immediate price action. Supply deficits only shape what happens afterward, during the recovery phase, when paper selling exhausts itself and physical buyers step in. This is where many confuse timing with direction. Silver can be structurally undersupplied, fundamentally bullish, positioned for long-term gains, and still experience violent drawdowns that destroy leveraged positions. Those drawdowns are not contradictions. They are not signs that the fundamental thesis is wrong. They are simply how the market resets, how excess leverage gets cleared, how crowded positioning gets unwound before the next leg higher can begin. Compare this year to last year one more time through this lens. Last year, silver's ascent was gradual initially, allowing time for positions to build slowly, for margin usage to remain manageable, for leverage to stay within reasonable boundaries. This year, momentum accelerated quickly, compressing time, reducing the buffer between normal positioning and dangerous positioning. When time compresses, when rallies happen faster than expected, reactions become sharper on both sides. This is why pullbacks now feel worse than last year's corrections, why they seem more violent, more capable of inflicting damage. The market is not weaker. It is carrying more tension, more concentrated positioning, more leverage waiting to unwind. Another verified observation involves volatility itself. Measured volatility in silver, calculated through standard deviation of price movements, has expanded significantly compared to the previous year. Wider daily ranges confirm this mathematically, not subjectively. High volatility environments create a paradox. They reward patience, the ability to wait for extreme prices before acting, to scale in gradually rather than all at once. But they punish leverage, even modest leverage, because swings become large enough to trigger stops or margin calls before the expected move materializes. This is where the warning becomes intensely practical. If someone hears Robert Kiyosaki say $200 silver and assumes they can ignore volatility, load up on maximum leverage, and simply hold through anything, they misunderstand silver completely. They are not positioned for success. They are positioned for liquidation. There exists a profound misconception about what supply actually does during moments of market stress. Most investors believe tight supply acts as a shield, protecting price from falling, creating a floor that cannot be breached. That belief is dangerously incomplete. Supply stress does not prevent volatility. It does not stop sharp corrections. It does not protect over-leveraged positions from forced liquidation. What supply stress does is far more subtle and far more important. It shapes what happens after the violence ends. Silver is not merely a financial instrument traded between speculators hoping for profit. It is a working metal, embedded in the physical economy, consumed daily by industries that cannot function without it. More than half of all global silver demand originates from industrial applications, not investment, not speculation, but actual consumption. This fact has been verified repeatedly through data published by industry research organizations. It is not disputed, it is fundamental. Solar panel manufacturing consumes massive quantities of silver, each panel requiring a precise amount that cannot be substituted with cheaper alternatives without sacrificing efficiency. Electronics production depends on silver's unique conductivity properties. Smartphones, computers, medical devices, all incorporating silver in ways that are technically irreplaceable. Electric vehicles use more silver per unit than traditional combustion vehicles, and global EV production continues expanding regardless of short-term price movements. Data, infrastructure, the server farms and network equipment powering the digital economy relies heavily on silver's superior performance characteristics. These sectors do not pause operations because futures traders panic. They do not cancel orders because leverage breaks in paper markets. They buy silver when they need it, based on production schedules, contract commitments, inventory requirements. That industrial buying creates a floor beneath silver price, but not the kind of floor most imagine. It is not a smooth horizontal line that price bounces off cleanly. It is an irregular surface, sometimes lower than expected, sometimes appearing only after severe drops. This is where the danger compounds for those who misunderstand the mechanism. People hear phrases like supply deficit and assume price should grind steadily higher, day after day, week after week. Silver does not behave that way. It never has. When supply is genuinely tight but liquidity remains thin, when physical availability decreases while paper trading dominates price discovery, price moves like water forced through a narrow pipe. Pressure builds behind it invisibly, accumulating force without obvious external signs. Then, when flow changes, when a large order hits the market or a margin call triggers cascading selling, price surges or drops with startling violence, seemingly disconnected from the underlying supply situation. This is why silver often appears weakest precisely when it is closest to strengthening again. The mechanics work against intuition. Now examine how conditions have shifted between last year and this year. Last year, industrial demand was rising steadily, but global inventories still provided some cushioning effect. When spot buyers needed metal immediately, when delivery timelines tightened unexpectedly, inventories could absorb the temporary imbalance. This year, that cushion has thinned considerably. Global silver inventories are not collapsing in total volume, but they have become increasingly uneven in distribution. Some geographic regions face genuine tightness, metal simply unavailable at reasonable premiums, regardless of willingness to pay. Other regions maintain comfortable inventory levels, metal accessible, delivery prompt. That geographic imbalance matters far more than aggregate global inventory numbers suggest. Markets do not price based on what exists somewhere in the world. They price based on what is available, where and when it is needed. When metal sits in London, but a buyer needs delivery in Shanghai, that metal might as well not exist for pricing purposes. Price reacts violently to even small shifts in regional demand because the system lacks flexibility, lacks the ability to quickly move physical metal from surplus regions to deficit regions. This is why silver volatility persists, even after initial corrections complete, even after forced selling appears to have exhausted itself. The underlying supply distribution remains problematic, creating ongoing potential for sudden price movements in either direction. Another verified factor requires examination: the nature of silver mine production itself. Silver does not come primarily from dedicated silver mines. It comes overwhelmingly as a byproduct of other metals mining operations. Copper mines, zinc mines, lead mines all produce silver as a secondary output. That byproduct nature has critical implications for how supply responds to price signals. Even if silver price rallies sharply, even if miners could theoretically profit from expanding silver production, so they cannot simply increase silver output independently. Silver production is tied to the economics of the primary metal being extracted, copper or zinc or lead. If copper prices do not support opening new mines or expanding existing operations, then silver production does not increase regardless of how high silver price rises. This creates a multi-year lag between price signals and supply response. New mine development takes 5 to 10 years minimum from discovery through production. Permitting alone can consume half that timeline. This means even explosive silver price appreciation today will not produce meaningful new supply until years into the future. That keeps long-term structural pressure intact, embedded in the system, unavoidable. But once again, this reality does not protect short-term holders from pain. Supply tightness functions like a stretched rubber band in this context. It stores energy, tremendous energy, capable of eventually propelling price much higher. But it does not control when that energy releases. It does not prevent the rubber band from being stretched further before it snaps back. Robert Kiyosaki's prediction leans heavily on this long-term supply constraint story. And that story is legitimate, grounded in verifiable data, supported by industry analysis. But where participants get hurt is assuming supply tightness guarantees near-term upside, smooth appreciation, protection from volatility. It does not guarantee any of those things. What it guarantees is volatility itself, sharp movements, sudden reversals, price action that confuses and exhausts holders. This is why silver's drops feel so psychologically difficult. So apparently contradictory to the fundamental narrative, investors expect tight supply to act as armor, defending their positions from downside. Instead, tight supply acts as tension, amplifying movements in both directions, making everything more extreme. And the tighter the underlying supply situation becomes, the sharper price movements grow when catalysts trigger. Now, layer in one more verified dimension: the behavior of silver inventories in major trading hubs. Over recent years, physical metal has flowed systematically toward regions offering higher premiums, stronger demand, more reliable contract enforcement. That flow creates regional stress points, areas where even small demand increases cannot be satisfied quickly. When one trading hub tightens, when available inventory drops below comfortable levels, price responds globally, even if other hubs still hold adequate metal, even if total worldwide inventory appears sufficient. Because the market price is based on the weakest link, not the strongest, silver behaves like a structure with multiple potential failure points. Any single point experiencing stress can affect the entire system. This also explains why silver often recovers faster than expected after sharp corrections. Once forced selling completes, once margin calls finish triggering, once over-leveraged positions liquidate, there's no equivalent downward force remaining. Paper sellers exhaust themselves. They have no metal to deliver. They were trading contracts, not commodity, but physical buyers remain waiting, patient, not chasing rallies, not selling in panic. They step in during weakness, not emotionally, but practically, recognizing opportunity when price disconnects from physical market reality. Industrial buyers maintain purchasing schedules. Long-term investors scale into positions. Jewelers restock inventory. This is where clarity becomes essential once more. A violent drop followed by price stabilization does not signal that danger has passed completely. It signals that the market is resetting, clearing excess, preparing for the next phase. Resets take time. They involve multiple swings, testing commitment, shaking out weak hands. Silver rarely transitions directly from excess straight into sustained calm. It oscillates, moves back and forth, creates false signals, exhausts participants psychologically before finally finding equilibrium. The most dangerous mistake an investor can make at this stage is expecting silver to provide answers it was never designed to give. Silver does not forecast its own future in straight lines. It does not telegraph intentions clearly. It does not cooperate with expectations. What silver does, and what matters most right now, is reveal where stress is accumulating beneath the surface. That is the signal worth watching. If Robert Kiyosaki's $200 prediction accomplished anything useful, it reminded the market just how extreme expectations have become. Not incorrect expectations, not foolish expectations, but extreme ones. And extreme expectations change behavior in predictable ways. They encourage aggressive positioning, they justify higher leverage, they create impatience where patience is required. When behavior shifts in those directions, risk shifts with it. That behavioral change is the real signal embedded in this moment. Right now, silver is not deciding its ultimate destination. It is not choosing between bull market continuation or complete reversal. It is deciding something more immediate. How much excess positioning must be cleared before the next sustainable move can begin. This is why the next phase will not be about price targets, about forecasting where silver goes by year end. It will be about reactions, about how the market responds to stress, about what those responses reveal regarding underlying stability. Watch carefully how silver behaves during down days, not up days. Up days are easy. They attract enthusiasm. They validate conviction. They make everyone feel intelligent. Down days reveal truth. Does selling accelerate immediately when price starts dropping, cascading lower as stop losses trigger and margin calls multiply? Or does selling stall quickly, finding natural buyers within a relatively narrow range, suggesting forced liquidation has largely completed? That distinction tells observers whether leverage remains dangerously high or whether the system has already cleared much of the excess. Volume matters more than headlines in this analysis. When price moves sharply but trading volume fades, when fewer contracts change hands despite volatile price action. That combination signals exhaustion, participants stepping back, reluctance to chase moves in either direction. When both price and volume rise together, when volatility attracts rather than repels participation, instability remains embedded in the system. Further violent moves are likely before any lasting equilibrium forms. Another key signal involves recovery speed after corrections. In healthy but volatile markets, silver rebounds quickly from sharp drops, often recovering half or more of the decline within days. In unhealthy markets, in systems where fundamental problems exist, price drifts lower slowly after initial drops, grinding participants down through steady deterioration. Right now, rebounds exist. Price does not simply collapse and stay collapsed, but those rebounds are uneven, sometimes strong, sometimes weak, lacking the consistency that would suggest the reset has finished. That unevenness suggests the process remains incomplete, not bearish, not signaling ultimate failure, simply unfinished. More volatility lies ahead before stability returns. Also watch gold, but do not expect silver to mirror it precisely. During stress phases, during periods when uncertainty rises and positioning becomes uncomfortable, silver often diverges from gold temporarily. Gold absorbs fear. Investors flee to it seeking safety, stability, preservation of capital. Silver amplifies emotion. It moves further, faster, in both directions, reflecting the dual nature of monetary asset and industrial commodity. If gold stabilizes while silver continues swinging wildly, that divergence is not weakness. It is silver behaving exactly as its structure dictates. It is normal, expected, even healthy in the context of how this market functions. Many holders misread this divergence completely. They assume silver must confirm gold's movements, must follow the same pattern, must validate the precious metals thesis in identical fashion. Silver does not work that way. Silver leads emotionally, reacting first to shifts in sentiment, exaggerating moves that gold makes more moderately, but silver lags structurally, taking longer to find equilibrium, oscillating more before settling. That is why its movements feel exaggerated, why participants experience whiplash, why conviction gets tested repeatedly. Another intensely practical warning involves time itself. The most financially painful losses in silver typically come not from being directionally wrong, but from being impatient, entering positions too aggressively after a sharp rally, adding leverage at exactly the wrong moment, assuming momentum will continue indefinitely, or exiting emotionally after a correction, selling near the bottom, abandoning the position precisely when probability favors reversal. Both mistakes stem from the same root cause: expectations outrunning market structure, conviction overwhelming discipline. This is why bold predictions must be handled with extreme care. They are not roadmaps. They do not provide step-by-step guidance through the volatility ahead. They are stress tests. They reveal who is positioned rationally and who is simply chasing, who has discipline and who is operating on hope. Silver exposes that difference faster than almost any other tradable asset. It punishes hope. It rewards preparation. Right now, in this specific environment, silver is testing discipline above all else. Not belief in the long-term case. That belief can remain intact. Not conviction that fundamentals support higher prices. That conviction may be entirely justified. Discipline. The ability to maintain proper position sizing, to avoid excessive leverage, to resist the temptation to force outcomes. If someone holds silver today, the most important skill they can develop is not forecasting ability. It is restraint, knowing when not to act, when to step back, when to let the market move without participation, knowing when volatility represents noise rather than actionable signal. This is where the warning gains its sharpest clarity. Silver can still move substantially higher over the coming months and years. Nothing in recent price behavior invalidates that possibility. Nothing in current volatility disproves the fundamental thesis. But silver does not reward certainty. It does not cooperate with rigid expectations. It rewards preparation, flexibility, the capacity to withstand discomfort without abandoning well-reasoned positions. This is not a market where investors can afford to fall asleep, to set positions and ignore them for months, to assume everything will simply work out. But it is also not a market where panic serves any useful purpose. where emotional reactions improve outcomes, where constant activity generates better results. It is a market that demands awareness, continuous monitoring, recognition of changing conditions. The warning is straightforward and undeniable. Silver is powerful, capable of generating exceptional returns for those positioned correctly. But it is sharp, unforgiving to those who handle it carelessly, who mistake volatility for opportunity without understanding the mechanics underneath. Handle silver like a precision tool, not like a lottery ticket, not like a promise that will deliver regardless of how it is managed. Those who respect silver's mechanics, who understand its dual nature, who position appropriately for its structural characteristics, they survive the violent swings. They maintain conviction through corrections. They emerge positioned for the next leg higher. Those who ignore those mechanics, who overlay simplified narratives onto complex reality, who expect smooth progression toward distant targets, they become part of the reset. Their forced selling creates the drops that shake confidence. Their liquidations provide the opportunity for disciplined buyers. That difference separates successful silver investors from casualties. And right now, that difference matters more than it has in years. The conversation around silver should not focus exclusively on price targets, on whether $200 is achievable or conservative. It should focus on behavior, on positioning, on risk management, on maintaining discipline when emotions run high. Because behavior reveals more than any prediction ever will. Behavior determines who survives volatility and who gets eliminated by it. Behavior separates those who benefit from silver's eventual move higher from those who watch it happen after being shaken out. And silver, in its own mechanical, unemotional way, is watching that behavior closely right now. It is measuring leverage, testing commitment, identifying who understands its nature and who does not. With that understanding firmly in place, silver does not need hype to move. It does not require cheerleading or promotional narratives. It moves when pressure builds to unsustainable levels, when structural forces overwhelm temporary resistance. Predictions can be useful. They can highlight potential. They can frame long-term scenarios, but only if investors understand the market those predictions land in, only if they recognize current conditions, only if they position accordingly. Right now, silver is not calm, it is not stable, and calm is not guaranteed to return quickly. The mistake is not believing silver can eventually reach much higher prices. The mistake is assuming the path will be easy, linear, cooperative with expectations. If you are watching silver closely right now, if you hold positions or are considering entry, stay focused on behavior, not noise, not headlines, not predictions divorced from current reality. Volatility itself is the signal. Discipline is the edge that separates success from failure. If this analysis helped clarify what silver is actually doing beneath the surface volatility, if it provided perspective that mainstream commentary typically misses, make sure you are subscribed to Currency Alert, because silver does not give second chances when it moves decisively. Share in the comments where you are watching from, what your experience has been navigating this volatile environment, and we will continue tracking what silver reveals next. Not what people hope it will do, but what it actually shows through price behavior and market mechanics. Because in the end, that is all that matters.